If you put $1,000 into Apple stock back in 1980, you'd have over $2 million today. But most people look at that and think, that's just luck. I missed the boat. But they're missing the point. The point isn't to figure out how to travel back in time to invest in Apple. Instead, it's to understand how to use stocks to protect yourself from future uncertainties like losing your job. Most of us were taught that a steady job is the safest thing in the world. But I learned the hard way that no job is steady and no job is safe. And here's what almost nobody tells you. There's a way to own a piece of the entire economy, not just one company, that turns the stock market from a gamble into a rock-solid shield, harder than Thor's abs. And I'm going to show you exactly how it works. I built a $500,000 portfolio by age 28. It wasn't for a nice Lambo, it was for survival. When I got laid off as a software engineer, that portfolio meant I didn't have to stress about a single bill while I pursued my actual passions. Today, I'm going to show you one specific piece of the puzzle I used to build that freedom. A lot of people think the stock market is like a casino, but that couldn't be further from the truth. For me, stocks were my life vest. Today, I'm going to show you exactly how they work, how they pay you, and the one cheat code I use to build a fortress that no employer can take away. Let's simplify some Wall Street jargon for a moment. Imagine you and your best friend want to start a cafe. You both put in $1,000 to pay for rent and buy supplies. You each own 50% of that shop, and you have a stock each. A stock basically tells the world, I own a piece of this business. With that stock, you are a shareholder, which basically means you're a partial owner of the business. When you buy the stock of a company like Apple, you're doing the exact same thing. You aren't just betting or gambling on a price. You're becoming a part owner of the buildings, the patents, and every single sale they make. Now, that doesn't mean you can walk out of an Apple store with their new iPhone 17 for free. I've tried, and the security guard wasn't too amused. But it does mean you get paid while you sleep. How? There are two ways. First, capital gains. Let's say you bought a share of Apple for $100 a few years ago. A share is basically a measurement unit for a stock. Just like how you would say a cup of coffee, you would say a share of Apple. Now, let's say Apple's stock price goes up to $200 because they become more profitable. If you sell your share, you will make $100. Second, dividends. Think of this as a check for your split of the profit. Not every company does this, but Apple does. It currently pays about $1 per share every single year, so if you have 100 shares of Apple, you would get $100 every year without lifting a finger. Now, I know what you're thinking. $1 per share doesn't sound like much, but here's the thing. Dividends compound over time. If you reinvest those dividends to buy more shares, those new shares also pay dividends, and you also get the capital gains on top of it. It's like planting a tree that grows more trees. This is how people build wealth quietly in the background while everybody else is chasing the next hot stock tip. But if stocks are so great, why does the price go up and down like a roller coaster? Because in the short term, the market is driven by human emotion. Imagine a fake news report that says Trump plans to go after Apple for secretly working with China. Suddenly, everyone is terrified. They start selling their shares for pennies just to get out. Does Apple still have the same working equipment? Yes. Is the iPhone still amazing? Well, I use an Android, so no. But to a lot of Apple enthusiasts, yes. The value of the business hasn't really changed, but the price dropped because of fear. This is the villain of investing. It's not the companies, it's not the stock market itself, it's us. Our own panic, our own greed. Although you can't control what others do, you can control what you do. Most people buy when they're greedy, when everyone else is talking about a stock and the price is sky high. Then they sell when they're scared, when the news is bad and the prices are crashing. Successful investors do the exact opposite. They understand how the market works. What do you want to do? The market isn't rigged against you. Your own fear is. Now, we have to be honest. Businesses can fail. Imagine a global pandemic hits. The city shuts down. The cafe that you started with your friend can't pay the rent for 6 months, and eventually, it closes its doors forever. In this scenario, your $1,000 investment goes to zero. This is the risk of owning just one stock. If you bet your entire survival on one shop, and that shop fails, you're back on the tightrope with no net. Let me give you a real example. In 2000, a company called Enron was one of the largest energy companies in America. Employees had their entire retirement savings in Enron stock. They thought it was safe because they worked there. They saw the offices, the revenue, the growth. Then, overnight, the company collapsed due to fraud. Thousands of people lost everything. Not because they were dumb, not because they didn't work hard, but because they put all of their eggs in one basket. Or take Blockbuster. In the early 2000s, it was the king of movie rentals. If you invested heavily in Blockbuster stock, you were a loss at all when Netflix came along. The business model died and so did the stock. This is why picking winners is a game most people lose. Even if you pick a great company, one bad executive decision, one new competitor, one scandal, and your entire investment can disappear. You can't predict the future. You don't know which companies will thrive and which will fail. And betting your financial security on that guess is not a strategy. It's a gamble. This is why so many people think the stock market is a casino. But there's an alternative to lower the risk to basically zero. And this is the puzzle piece that saved my life. Instead of buying one cafe, imagine you could buy a tiny piece of every single shop in the country. How amazing would that be? If one shop fails, it wouldn't affect you much. In the stock market, you would do this through an index fund. It's like buying the entire mall instead of just one store. An index fund is a collection of hundreds, sometimes thousands of companies all bundled together. When you buy a share of an index fund, you're buying a tiny piece of Apple, Google, and hundreds of other businesses all at once. If 10 companies fail, it doesn't matter because the other 490 are still growing and paying you. Here's the magic. Over the last 100 years, the US stock market has grown an average of about 10% per year. Not every year, obviously. Some year it crashes, some year it soars, but over time, the trend is up. Because even though individual companies fail, the economy as a whole keeps growing. Put differently, would you expect the price of a coffee to go up or down 40 years from now? The population grows, technology improves, productivity increases. And when you own the entire market through an index fund, you're betting on that growth, not on whether one CEO makes a good decision. This is the cheat code. You don't need to be a math genius or millionaire to do this. You just need to stop betting on companies and start betting on the entire economy. This is how I built my $500,000 safety net that protected me during my layoff. I didn't pick the next Apple. I didn't time the market. I just consistently bought pieces of the whole economy year after year and let time do the work. You now know more about stocks than 90% of the population. You know they are ownership, not gambling. You know the two ways they make money for you while you sleep. You know why emotion is the enemy. You know why single stocks are dangerous, and you know why owning them all is the ultimate safety net. But knowledge is useless without action. So what's next? You have the theory, now you need to do something. In my next video, I'm going to show you exactly how to buy your first stock or index fund for less than $10 in under 15 minutes. Because here's the truth, the best time to start was 10 years ago. The second best time is right now. And the longer you wait, the more money you're leaving on the table. If you found this helpful, make sure to hit subscribe and I'll see you in the next one.